I'm glad you brought up the subject of the annual report, because what I was doing in the annual report is I had talked about Coke and Gillette as being the inevitables and what wonderful businesses they were. And I thought it appropriate, particularly the report goes to a lot of people, that they would not take that as an unqualified buy recommendation about the companies, because they're absolutely wonderful companies run by outstanding managers. But you can pay too much, at least in the short run, for businesses like that. So I thought it was only appropriate to point out that no matter how wonderful a business it is, that there always is a risk that you will pay a price where it will take a few years for the business to catch, or for the business to catch up with the stock, that the stock can get ahead of the business. And I don't know where that point is with those companies or any other companies, but I did say that I thought that the risks were fairly high, that situation existed with most securities in the market, including companies such as Inevitable. But it was designed to be sure that people did not take the remarks that I made about those companies and just take that as an unqualified buy recommendation regardless of price. We have no intention of selling those two stocks. We wouldn't sell them if they were selling at prices considerably higher than they are now. But I didn't want particularly relatively unsophisticated people to see those names there and then think this guy is touting these as a wonderful buy. Generally speaking, I think if you're sure enough about a business being wonderful, it's more important to be certain about the business being a wonderful business than it is to be certain that the price is not 10% too high or 5% too high or something of the sort. And that's a philosophy that I came slowly to. I originally was incredibly price conscious. We used to have prayer meetings before we would raise our bid, and I originally was incredibly price conscious. We used to have prayer meetings before we would raise our bid in around 8. I mean, we've missed things because of that. And so what I said in the report was not a market prediction in any sense. We never try to predict the stock market. We do try to price securities. We try to price businesses is what we try to do. And we find it hard to find wonderful, good, average, substandard businesses that look to us like they're cheap now. But you don't always get a chance to buy things cheap. Charlie?
Well, I certainly agree with that. The one thing we can confidently guarantee is that real inflation-adjusted returns from investing in a standard collection of stocks will be lower in the long-term future than they've been in the last 15 years or so. This has been an unprecedented period, and there will be some regression toward the mean in average returns from investing in the stock market.
American business has done extraordinarily well in the last decade plus, and that's a huge plus for securities because they just represent pieces of those businesses. Interest rates over the last 15 years have fallen. That's a big plus for stocks. Anytime interest rates go down, the value of every financial asset goes up in a rational calculation. Both of those factors have combined in recent years to produce conditions that enhance the true value of American business. But those are pretty widely recognized now, and after a while, Ben Graham always used to say you can get in more trouble in investment with a good premise than with a bad premise, because the bad premise will shout out to you immediately as being fallacious, whereas with a good premise it'll work for a while. Businesses are worth more money if interest rates fall and stocks rise, but that eventually the market action of the securities themselves creates its own rationale for a large crop of buyers, and people forget about the reasons and the mathematical limitations that were implied in what got them excited in the first place. And after a while, rising prices themselves alone will keep people excited and cause more people to enter the game, and therefore the good premise after a while is forgotten, except for the fact that it produced these rising prices, and the prices themselves take over. He wrote about that in the connection with the 1920s, when Edgar Lawrence Smith in 1924 wrote a a fine book on why stocks were better than bonds, and that was sort of the Bible of the bull market of the 20s, and it made sense if you paid attention to a couple of the caveats which were in Edgar Lawrence Smith's little book, which was related to price. But people tend to forget about the importance of the price they pay, as the experience of a bull market just sort of dulls the senses generally.
Mr. Buffett, my name is JP from Singapore. I flew 24 hours to get here. Mr. Buffett, throughout your life, you have repeatedly under-promised and over-delivered. For many recent years, for example, you have targeted Berkshire Hathaway's long-term book value growth at 15%, yet you have come through at about 24%. That is a big gap of 9% between your modesty and the outcome. Perhaps the biggest dose of modesty in corporate history. May I ask, why is there such a big gap between your modesty and the outcome?
I don't think it was modesty. I think it was, for one thing, we've had a terrific market that has reappraised all businesses in the last 10 or 15 years. So when we really started worrying about future performance, the key factor was having larger amounts of capital. And there's no question that the larger the amount of capital you work with, the more difficult the job is. Now, we were fortunate that ascension in capital happened to coincide with things that just lifted all the boats substantially. And so we have had better luck than I would have guessed we would have had 10 years ago or 5 years ago. But it's been aided by a huge tailwind, and 10 years ago or 5 years ago. But it's been aided by a huge tailwind, and it's done as well in absolute terms. And we won't have that tailwind in the future. I can assure you of that. But we will have the larger amount of capital, which is the anchor that works on us. So if Charlie and I could make a deal to increase the intrinsic value of Berkshire at 15% a year over the next 10 years, we would sign up now. And I don't want you to even tempt us with lower numbers, because those numbers get astounding. If we paid no dividend at all over a 10-year period, you can figure out where a 15% rate would take us. And we hope to get there, but we think that is absolutely the tops. And I think it's very likely for a period when the market starts underperforming businesses, that the rate could be very substantially lower than that. Charlie, do you want to expand on that?
Well, the questioner came from Singapore, which has perhaps the best economic record in the history of developing an economy, and therefore he referred to 15% per annum as modest. It's not modest, it's arrogant. And only somebody from Singapore would call it modest.
Yeah. Be careful, Charlie, or they'll have a voice vote that we should move to Singapore. I mean, this is the group that wants performance. Large quantities of money are not going to compound at super rates, at super compound rate. Small sums probably aren't either, but large sums aren't. And if anybody that manages large sums of money that promises or implies that they can achieve really outstanding returns, I'd stay away from them. The numbers just get too big, and you've seen some of that with certain money management organizations in recent years, and 15% on an intrinsic value which is substantially greater than our book value gets to be a very, very big number. And we need huge ideas. We don't need thousands of ideas. I mean, we might need them, but we could never come up with them. So what we look for is the very large idea, but we're not finding them now, and we'll keep looking, and every now and then we will find something. But it really, if you think we're going to have any chance of doing better than 15%. And believe me, that is no number that I'd want to sign my name to, but you really shouldn't. You're going to be disappointed in Berkshire, and we don't want to disappoint you, so that's the reason we try to be realistic about expectations. Zone 6.
My name is Darrell Patrick from Dayton, Ohio. How many shareholders do you have that have owned Berkshire longer than you and Charlie, and have you ever gotten together with them?
How many shareholders have had it longer than we have? Well, we started buying in 1962, and it was I think the first ticket was at 7 5/8 or thereabouts, but it was 2,000 shares. I've got the trading card on the wall, and I paid a dime commission. I can't believe I was paying a dime commission in those days. We pay a nickel now, and that's on much higher priced stocks. It's a good thing I didn't have a fist fight with a broker about whether to pay it or not. I might not have those 2,000 shares. We have, as a director, Kim Chase and his family's holdings in Berkshire go back to what? Kim, where are you down here? There we are. What year would you? The 20s, yeah. The Chase family has been in Berkshire since the 20s. But I would say we bought about 70% of the Buffett partnership, which was a partnership I ran in the 60s, bought about 70% of the company. So that means there were 300,000 shares roughly that were not owned by us. Aside from the Chase family, I'm sure there are people that, I'm sure we've got, 50 or 100 shareholders maybe from that earlier date that are still around, and I'm glad they are. Charlie?
Nothing to add.
Zone 5, please.
I'm Eric Butler from Menlo Park, California. A couple of questions, one serious, one not quite. Considering Berkshire Hathaway is well run at low cost and is diversified, why should anyone do anything but put all their money into Berkshire Hathaway instead of maintaining a diversified portfolio? And in some of these hagiographic kind of biographies, it is apparent that you have other investments yourself beyond Berkshire Hathaway. The second question I had, is there any significance to the fact that the Omaha World Herald does not include Berkshire Hathaway in its stock tables on any day? Is this a sign that they do not honor profits?
No, they actually they have a separate little table called Midlands. I think it's entitled Midlands Investment, but they pick out about 50 stocks that are of particular interest to people in this area, and they lift those from the regular table and put it in this separate table, which is usually on a second page right following the main stock table. So they give us our just due on that, but you do have to, you should look in a different table for that. Second question about putting all your money in, I've got 99% of my money in Berkshire, but it was bought at a different price. And Charlie's was bought a little cheaper too, I think. So, we like the idea of having it all in there, but we don't recommend that people do that because you will get very low cost management. What we hope is that from this point forward that cost does not reflect its value. But the price at which you enter is very important. You do get a great group of businesses. You get a lot of great operating managers. You get very reasonable costs. But that is fairly widely recognized now compared to the past, and people pay more for it than they used to. I'm still very comfortable with it, and I think Charlie's comfortable with it too. But everyone has to make up their own mind about price. Charlie?
Yeah, eventually, if the success continues and we have more of this hagiography, the stock will get such a high price that it's no longer sensible at all to buy. We hope we dampen that process as we go along, and of course there's always the very substantial chance that we'll just fail to meet expectations due to the vicissitudes of life.
falling on our face is what we call it.
Yes.